Hi everyone. So I hope everyone's well. Having a good week so far. So this month's webinar is all about the pitfalls of the buy-to-let market. Now it's something that I really want to push and get over to clients because it's very easy to get swept up with any agent, whether it's us, whether it's another agent that you've been speaking with. And it's very easily to get swept up on a crest of a wave, thinking that everything's rosy, everything's looking great, house prices are moving up. Now, whilst that is great and it's good news for anyone who has bought over the years, we also have to look at the pitfalls. Now, these aren't just pitfalls that are in the place now. These are pitfalls that have been there for years, but have often people overlook. So I want to cover that. The way I look at investing is that there's going to be negatives in everything. So you've got pitfalls of keeping your money in savings accounts, that being the fact that inflation erodes the actual interest. There's pitfalls of investing in the stock market, things like, we see it's a very liquid market, therefore it moves up very quickly, but also down as well. And there's pitfalls in investing in the buy-to-let market. The way I look at it is, if I can get all the negatives down on a piece of paper and I can cope with all the negatives, then I'm comfortable. That's the most important thing for me. If I can deal with all my negatives and all the risks that are associated with any investment, wherever I invest, and I can deal with that, then no problem at all. So, for example, if you put money in the stock market and you go with a small market cap share and it's a high risk share, well, the advantage is that it can go up a lot in a short space of time, but the downside is it could go to zero. If you're happy with that risk, no problem. It's something that people move forward with. But what I'm going to look at today is obviously all the negatives of the buy-to-let market, but also the flip side of each negative as well. So let's, without further ado, head straight in. So obviously we've got what we all know. We all know that there have been a couple of major crashes in the property market over the last sort of 20, 30 years. We've had the late 80s and early 90s where the interest rate went so high that people couldn't afford the mortgages, prices crashed. And again, similar thing in sort of 2008, 2009. That was more to do with liquidity of banks, lack of lending, and again we saw a crash then. So what we have to look at here is the pitfalls that are going to take place now and have been in place sort of over the last couple of decades. So first of all, we're going to look at the pitfalls, and then we're going to look at the flip side to each particular pitfall. Pitfall one is the liquidity or the lack of it in the case of the property market. When you invest in the stock market, you've got, or you leave it in your bank, you've got pretty much instant access to that money. With the property market, you don't. Now, in times like now, it's very easy to sell. It's a seller's market at the moment. Houses and flats and apartments and commercial property are selling quicker than they ever have done. There was an article in the Telegraph and on the BBC today which says that house prices have had one of their best ever years in history. So it's all well and good looking at that side of things. What we have to look at is in times when we're in either a downturn or a more slower market, and we have to look at the lack of liquidity. So if you're someone, for example, that may need that money, so what I say to everyone is, as we increase in years, we may need that money more instantaneously. As people get older and they retire, if anything happens health-wise, and you think, do you know what, I need that money for a rainy day to put aside in case I need to pay for private medical care. If you've got it in property, there may be a lack of liquidity that you can't instantaneously release that money. So that's something that you've got to take into consideration. Now, there's a flip side to that, which we'll come to at the end. But the first pitfall is that there's a lack of liquidity, and it can take months, because you're not just looking at the sale of the property. So it's not just you get an agent round, they value your property, you get it sold on the market. That might only take 3 to 4 weeks. You've then got to go through the process of the solicitor and getting things sold. So and getting things or do all the conveyancing, which might take another 2 to 3 months. So you may be looking at 3 to 4 month time period from you thinking about you need the money to actually being having the money within your bank. So that's pitfall number one. Pitfall number two is not thinking about all of the costs. Now, this is one of the biggest mistakes amateur investors make. They look at on the face of it, well, actually, I've got costs associated with an apartment, for example, whether that be your service charge, my mortgage, and that's it. What they don't look at is some deeper costs associated with not only apartments but also houses as well. So, for example, when you purchase a house, you've got insurance costs. You've got to insure that particular property. Now, that insurance might be increased because it's a buy-to-let. So, if you've got a freehold house, you've got insurance costs that you've got to factor in, year out. Also, if you've got a house with a garden and a drive, you've got to think about maintenance, because if you ever have void periods, it's got to be you that maintains that garden. It may even be in the contract when you have a tenant in there that they maintain it, but apart from that, it's going to be you that's going to be maintaining it. The tenant typically won't be painting things like wooden fences or any wooden trellises or anything like that. And I know that sounds a bit minor detail, but you'll be surprised how much things like that add up and eat into your profit. Now, one of the biggest things people don't take into account is tax. A lot of people on the face of it, they think that, well, okay, I'm going to make £10,000 this year. And what they don't look at is actually the tax that they're going to pay on it, because many people don't know that a buy-to-let might take them into the next bracket up. So you might be going from the 20% into the 40% bracket. Again, if you're overseas, there's a slight different legislation. You'll sign what's called an NRL 1 form, non-resident landlord 1, which means that you can apply for the basic rate tax allowance until you start to get taxed. So again, you have to look at the tax, because then you've got to ask yourself, well, actually, am I going to do a traditional buy-to-let on this, or am I going to do a short-term buy-to-let? So if you do a short-term buy-to-let, then actually your tax bill will be different, because obviously on the short-term buy-to-let, as long as it meets certain criteria, which we can go into more depth on another webinar, but as long as it meets certain criteria, you'll get taxed on your net profit. Whereas if you're doing a traditional let, you get taxed on your gross profit. So you'll get taxed and then you start to take the cost out, and it actually can make quite a big difference to what you end up with. So that's something that's imperative as well. And before any of our brokers recommend a product, I will definitely be asking and speaking to them about different options, the ways to let your property, and the kind of tax implications about that. But importantly, you've got to speak to your own accountant, because they will know your personal circumstances far better than we do. So it's definitely worth speaking to your personal advisor about that. After tax, obviously, we've got things like your ground rent. Now, ground rent is something that is going to be phased out. There's no shadow of a doubt that 5-6 years ago, there was a lot of talk about ground rent and implications. I can guarantee you, in the next 10 years, we won't even hear about ground rent. It will be what's called a peppercorn ground rent, which is basically nothing. Ground rent legislation has changed. The government are trying to eradicate it. There was horrific examples where houses were actually sold as leasehold by major house builders, and what was actually happening is they were doubling the ground rent every 10 years. So it might seem okay at the start, you got a £500 ground rent, then it's obviously 1,000, 2, 4, 8. Suddenly after 40 years, you're paying £8,000 ground rent. So they eradicated that. But what we're noticing now is a lot of lenders want ground rent outside of London, either £250 at max or 0.1% of the property price. So if your property price is 350, that's fine to be £350 ground rent, because it meets the 0.1%. In London, it can be up to £1,000, but outside they want it either 0.1% or capped at 250. And again, mortgage brokers and mortgage lenders are looking at that in far stricter detail. So if you've got a project that is £300, £400, £500 ground rent, and is a new build, on some of the older builds it's not an issue, but on a new build, and it doesn't meet that 0.1% or the 250 rule, then you're going to be struggling. Also, another thing where people struggle with mortgages, where they don't look, is the guaranteed rental side. There's a lot of companies which sell guaranteed rentals, 8, 9, 10%, looks great on the face of it, but then you probably and most definitely won't be able to get a mortgage. And as much as you will speak to that broker's or that agent's in-house mortgage broker who tells you you can get one, they're probably telling you the truth. You can get one, but you'll be paying 6, 7% for it, and it suddenly eradicates all your returns. And then the biggest concern is when the guaranteed figure drops off, what are you then left with? Now, it works on student property, no problem, but it doesn't work on residential property. the way you want to look at a residential property is if that property can't be let for 8% on a normal traditional buy-to-let, then they can't guarantee it. There's something wrong. So that's the way I would look at it. And also, you might think, well, I can pay cash, so I don't need a mortgage. Don't think about what you're going to do. Think about when you're going to sell it and the person that's looking to buy it. So that's a pitfall that you've got to take into consideration there. It's when you're looking to sell it and the next person can't get a mortgage, so you're now selling to a cash buyer. Stamp duty as well. Again, a lot of people don't take into account stamp duty. They think of it as a cost that's there, but don't think about what it is. So that's something also that's needed. Mortgage, and this might sound obvious, that how can people not think about the mortgage, but what they do is they get given a rate quoted to them, and they don't think that actually that rate is only assured for 2 years or 5 years or whatever they sign up for. So let's sign you up, let's say you sign up to a rate of 2.5% or 3% for 2 year period. That's great, you've got your 2 years, but what after that? What does it go to? Does it go to a variable rate? Is it 4% above Bank of England rate? What is that rate going to be? So factor that in. If you say, well, it doesn't matter, I'm going to then get another mortgage in 2 years' time where I'll lower my rate, no problem. But have you factored in the extra £1,000, for example, that it's going to cost you for that particular mortgage? So all these things need to be factored in as well. Management and lettings fees. So, for example, if you're not going to do it yourself, which I strongly suggest that you don't, I always say you use a professional for each and every job. You wouldn't want to be changing electrics, lights, and doing plumbing work. So why think you can go and manage a property? Leave it to a professional company who have got the experience of managing. They've got the experience of doing the vettings, the contracts, and literally you'll have a far easier time of it than you trying to do the lettings yourself. You might think that you're going to save, £600 a year, for example, but actually you probably spend more than that on a cup of coffee every day. So the argument is, don't do it, because it typically doesn't work out well. Leave a professional to do the management lettings, but those fees do have to be factored in. And also, how I say, when you're looking at house insurance, as I mentioned above, with a leasehold property, you would typically get that within the service charge, so that is actually covered anyway. So thinking about cost is basically pitfall number 2. Make sure every single cost has been accounted for. Could be anything, could even be a trip from you to go from A to B to the property. If you're going to drive 100, 150 miles, well, what's your petrol cost? If you do it twice a year, what does that add up to? As we then head on to pitfall number 3, bad tenants. This is probably the worst of all. Doesn't matter what kind of property you own, whether it's house, flat, commercial. If you get a bad tenant in there, it's a nightmare, logistical and financial nightmare, because as soon as COVID hit, the rules changed from actually evicting people and getting them out. And if you're not getting your rental come in, then suddenly you're still paying your mortgage month in, month out. Imagine having a £10,000 deficit where you paid your mortgage for 12 months and the tenant hasn't paid their actual rent. So bad tenants. Now, what typically constitutes a bad tenant? Well, it's always one that doesn't pay rent, but how do they come about? Well, typically they come about from a lack of vetting. Goes back to pitfall 2, where you try and do the management yourself. There's a lack of vetting, a lack of qualification, but also there's a lack of regular contact. What the best management companies will do is they'll go up there every month, have a chat, go in, see how they're treating the place. That's what we do as a management agent. Again, I know a lot of letting agents, they leave it 6 months and hope for the best, or leave it a year sometimes, typically. Worst case, some never go in. But again, you're asking for trouble. You've got to regularly go in and see the tenant, see how things are going. But also another pitfall that people make is they buy cheap property. They think that actually I've got 100, 200, whatever, however much money they've got, and rather than buying 1 apartment or 2 apartments, they'll go and buy 5 or 6 on the outskirts, in a rundown area, and it might, on the face of it, look better. But the reality is, if you're buying properties that are sort of £30,000 or £40,000 for a house, you're going to get a tenant in it that potentially won't treat that house very well, or potentially won't pay. So you've got to look at the demographic that you're aiming at. Young professional demographic is kind of where you want to be. Void periods as well. So you head down to a number of properties where we've seen, especially people who became accidental landlords back in sort of the mid 2000s, and then people who purchased cheap properties back in sort of 2008-9. They then had huge void periods, because what happened is, if you purchased in 2007 and 8, your property potentially then fell 15%. That meant that your tenant could then suddenly afford a property, so they went out and purchased. The downside of that is if tenants are purchasing, well, they're not renting, so you've then got void periods. Excuse me. So what you've got to look at is, where are the void periods typically? They're typically on the outskirts, but also if they're on the outskirts, then you've got to really stick to city centres. Now, there are some outskirts that are better than others, so we're not totally adverse to the outskirts. But what we would say to people is, look, your city centre doesn't matter about COVID. A lot of people say, well, haven't people moved out? Look, you will have had people with children move out and look for gardens, but a younger demographic will still want to be in the hub of it. You're not going to have, or very rarely, you're going to have a 25, 26-year-old saying, do you know what, I want to go and move out in the country, you know, with big gardens and things like that. They still want to be in the hub of it, especially after lockdown. If you've got a younger demographic, a young professional who's been literally locked up in their house and cooped up for, you know, X amount of months, they want to get out to restaurants, bars, see their friends. And where that happens is city centres. We're seeing people flood back to London after the lifting. I think that's only going to get more and more as we ease up in July. I think come September, when furlough ends, you're going to see the whole market get flooded again. As I say, we're based in Canary Wharf, and we've seen it from being insanely busy to when COVID hit, to when no one was coming in. And literally, you could look down from our building, you'd see 2 or 3 people, to being relatively busy again. And I think it's going to go the next level up as well. So void periods are best avoided with better quality properties. Also, interest rate changes. Again, what we look at is we look at interest rates. Now, traders do this all the time. Traders are always predicting and betting on actually what the interest rates are going to be. So we will look at interest rate futures, is what they're called, and we will look at where those interest rates are predicted to be. So if you've got an interest rates that are predicted to jump up by 2 or 3%, 2 or 3% might not sound a lot, but if you're only paying 2 or 3% on your mortgage, well, actually your mortgage has just doubled. So we need to look at interest rates, where they're going, where it's predicted. So my advice to everyone is, if you're looking at interest rate increases in the short term, you may want to be better to sign up to a mortgage that actually is a 5-year mortgage, because you've got more security, and as long as you're going to hold the property for 5 years, that is, but you've got more of a long-term plan of what your mortgage rate is going to be. If you think, well, interest rates are going to remain where they are, then a two-year fixed is probably no problem for you. But again, a lender should have a really good handle on what the rates are going to be. So I would personally be really looking at interest rate changes and where things are going. Now, of course, that's the main pitfalls. There are other pitfalls, of course, associated with property. But again, as long as you've got the costs down to a T, as long as you can fully appreciate the lack of liquidity, the bad tenants, the void periods, and the interest rate changes, you've probably got the majority of the negatives covered. Now, don't get me wrong, guys, we're only skimming through this. This is 15-minute chat. You need to spend hours, or get a broker like ourselves to spend hours doing the work for you and making 5-year predictions in terms of the property, you know, predicting where things are going to go. We can sit down and help with all that. That's what we get paid for. Or go and do it yourself, you know, but just make sure it gets done, because that's the difference between an investment that works out okay or an investment that's absolutely spot on and you know exactly where you stand every step of the way. But there's a flip side. So a lot of the negatives also do have a flip side for the positive as well. So obviously we spoke about the lack of liquidity. Now, again, if you want liquidity, you either leave it in the bank, or you put it into a stock market, which you can sell instantaneously. However, the lack of liquidity also means that you don't find the property market crash as quick as the stock market does. There's more time. So if we go back to even 2008 and 2009, although the property market was falling, at worst it fell just over 15%, 15, that is 15%. So you've got time to sell your property. It might take longer to sell, but you've got time before it goes from top to bottom. It doesn't happen overnight. Whereas typically the stock market does. You can see, well, we saw back in March 2020, April 2020, the stock market go from over 7,000 points to just under 5,000 points. So you're looking at a 2,000 drop. So you're looking at sort of a 30% drop within a matter of weeks. Again, the property market just simply doesn't do that. And again, we look at savings rates. You could put your money in, keep your money in savings, but everyone knows what they're getting in savings. And the reality is inflation is more than what you're getting in savings. Therefore, you're actually losing money by just keeping it in the bank. So typically the property market is a more stable market over a longer period of time. And I personally never seen a property go to zero. I've seen stocks go to zero, but I've never seen a property go to zero. And I think that's the beauty of property as well. And again, the flip side, cost to the mortgage. So although the mortgage is something you've got to take into consideration, effectively it's free money. Now, the reason why we say it's free money, a lot of people say, well, I've got to pay an interest on it. If you've got £50,000, let's go very round figures, very, very crude calculations here, but if you've got £50,000, typically you will be able to borrow 150. So you'll have a total investment of £200,000. So if you go and put that £200,000 into a property and you make, again, round figures, let's say you make 5% income and 5% growth. So you're going to make 10%. So 5% income, 5% growth. You're actually making 5% income on the 200,000, and you're making 5% growth on the 200,000. Whereas if you took that same 50,000 and left it in the stock market, and let's say the same thing happened, you made 5% income from dividends and 5% growth, you would only make your 10% on the 50,000, not the 200,000. Now, of course, the extra 150,000 that you've borrowed, you might be paying 3% on it. But if you're making 10% within the income and the growth, you've actually netted 7. So that's why we say it's free money. It's effectively money that you've got, and yes, you might be paying 3% on it, but the reality is if you're making 10% in income and growth, you've got 7% net income on money that is just simply not yours. You can't do that unless you trade a certain type of instrument in the stock market, which most amateur investors won't trade. So typically, when you invest in the stock market, you've only got your initial cash that you're putting in. With the property market, you can leverage, and that's where the money's made in the property market in comparison to things like the stock market or your savings rates. And as we go in here, we go into a little bit more detail. As I say, if you've got 50,000 and you put it in the stock market, it's only that 50,000. So you make the 10% in that, you've got your £5,000 if you put it in the stock market. Whereas if you put it in the property market and you make 10%, you're making £20,000. So you've got an additional 15,000 on top. Yes, you've got costs out of that, but you get where we're going with that. So there is a flip side to actually putting it in and having mortgage costs. So all in all, there's a lot of negatives, of course, that you have to take into consideration, but there is a flip side to everything. And again, the same with the interest rates. Just look at the interest rates, and for me, I always look at interest rates and think, you know what, they're probably worth fixing for as long as possible. If you've got a really good mortgage, tie that in. If you've got a really good mortgage, I've heard of clients recently getting 1.89s and 1.99%. For me, I'd be tying them in for as long as possible. That is a great rate that you can calculate for long term, where you're going to actually be with everything. So that's the majority of it, guys. As I say, there are other pitfalls, there are other upsides, and if anyone wants to speak in more detail about this, feel free to get in contact with us. All of our brokers are going to be in contact with you guys at some point next week. It won't be this week. It will be next week. They'll be in contact to see if you guys want any more help with anything at all. Don't forget, we are a company that will give you a bespoke plan. We're not going to be someone who just sort of sends out information and hopes for the best. We want to give you a bespoke rundown. We want to ensure that you've got the 5-year plans, you've got the predicted growth, not just predicted growth from us. Any agent can get on the phone and tell you things are looking great and it's going to go up. That's not what we're about. We want to give you, reports from Savills, Knight Frank, these kind of companies that are long established in the property world, and we can give you figures based on the back of their predictions. And the majority of them, I say, apart from when they go a bit off the beaten track and predict ridiculous things like during COVID that they did, the majority of them are actually pretty on point with companies like Savills. So we can put plans together for you, and we'll make sure that we get something bespoke. It's not just about trying to ram you into a product. It's trying to find the right product that's going to suit you, your time frame wise, whether you're looking at 2 years, 5 years, 10 years, etc. over to you guys now. Any questions at all? There should be say a speech bubble or question mark on the right hand side, and you can sort of write out any questions that you guys might have. Got one here saying, I already have a property I'm looking to buy from my dad. Do we have any mortgage consultations? Yeah, we don't have a mortgage broker in-house. We have recommended brokers. If you take my email address down at the bottom of the screen now, just send me an email and I'll put you in touch with a couple of brokers, whether you're UK based or whether you're overseas. We have brokers for that. The reason why we don't have them in-house is we find it a bit of a conflict of interest, because we'd rather you get a true transparent view on the mortgages rather than actually having sort of someone in-house who's just going to tell you what we want them or what we want you to hear. So I know some agents have them in-house, but it's not something we recommend, because in our opinion there's a bit of a conflict of interest there. But we can definitely recommend you a potential mortgage broker. Next, hi Chris, on the ground rent point, what's the current time frame around those restrictions? Yeah, really good question. So they're kind of coming in terms of older builds, because there's two sides to this. So you typically have two sides of the coin. So you've got the older properties where they're not going to change the lease. So let's say that lease was done 3, 5, 10, 20 years ago, whenever it was. They're not going to change that lease. They're not going to suddenly turn around and say, well, the rent was $350, the ground rent, sorry, was £350 per year, and we're now going to change that down to 250 or 0.1%. They won't change it. The lease has already been done. Probably the freehold has been sold on. Mortgage brokers are aware of that. They've got no problems with that. I'll come back to that in a minute because there will be some implications for those people, but I'll come back to that. Where they're looking, guys, and where they're really looking to be hot on are the new builds. The majority of new builds at the moment, they really have to meet stipulations of 0.1% or that £250. Now, we do have products, but for example, we've got there's one particular developer called X1, and they have ground rent of sort of £350, and it's tough. That's the bottom line. It's tough. They've got great projects, but we keep saying to them, change your ground rent. You're causing yourself no end of issues by not changing your ground rent, because you're a new build. You can change it at that point. So what's basically happening is they're sticking to their guns. They're charging £350, and of course, every time someone goes to get a valuation for the mortgage, they get declined. So they then have to pay the client back the mortgage fee and the reservation fee. It doesn't make sense. So I would say, in answer to your question, older properties, not so much of an issue. Newer properties, I'd really be stipulating, your lease to be ground rent of 250 or 0.1%. That's what I'd be looking at. Now, going on to the extension of the lease, because that's another side that the government are looking to change. Whereas previously you would have extended the lease, and a lot of people think that you can't extend the lease, or when my lease runs out, I just give the property back. It's not as straightforward as that. I would always say anything below 80, 85 years, you're starting to accumulate a lot of costs that could be associated with this. Anything before that, if you've got a project which has got a 90, 95, 100-year lease left on it, you can go to the freeholder and say, well, I want to extend it by 90 years. That was the normal statutory term. Extend it for 90 years for a certain amount. If they agreed, you went through. If they didn't agree to it, then you would have to go to sort of like some kind of panel where you would have someone go and value your property, and it would be a percentage of the value of the property. But again, you're talking maybe 4, 5, 6,000, depending on the value of the property. However, where the government are looking to change it is, whereas before it was a 90-year extension, they're looking to change that to say you can go right the way up to 999 years, and for a lot cheaper and more straightforward. So being more cost effective for the actual landlord rather than being better off for the freeholder. So all of that will start to come in. Again, it won't be instantaneous. We're seeing lenders already take up the government's advice, even though it's not in legislation yet, the government's advice, I should say. But I do feel that over the next sort of few years, this will, ground rent will pretty much be phased out. And once the stipulation comes in that you can buy your 999-year lease, once you do that, you don't carry on paying ground rent, by the way. Once you get your 999-year lease, you paid, let's say you paid 4 or 5 grand for it, that's it. You don't pay ground rent anymore because you've effectively paid off your ground rent. So there's that advantage as well. But as I say, in terms of the older properties, it doesn't affect anything. But I'd always speak to your broker in regards to what it could mean for you. Next question here is, what kind of plans do you do for each client? So yeah, good question. Depends on how much the client wants. Some clients are pretty comfortable doing it themselves. Some want really in-depth figures and plans. We'll do as much or as little as you need. So what we typically do is the very first call, we try and be more consultative than sales. Don't get me wrong, that's our job. Every time we do a sale, we make money. That's how the business works. But again, what we prefer to do is do a more consultative approach, because if we make sure that we get you the right product at the start, then we know that the reality is that you'll come back to us or you'll recommend us and things will go well. Are we perfect? No, we don't get everything right, 100% of the time. But what we will do is, if there's anything ever that we get slightly off track, we'll work as hard as we can to correct things for you guys. So what we do is the first call or the first consultation is all about you, why you're buying. For example, if you're buying for your kids and your kids' university funds, and they're 10 and you're looking for an 8-year plan for them, but that's different if you're buying because you want extra holidays for the next 20, 30 years, or maybe you want something for the next 2 years. So where we recommend in terms of the areas and the products all depend on you and your time frame. Also, your budget comes into that. If you've got a 30 grand budget, we don't want to go right up to the 30 grand to leave you with nothing. We want to leave a little bit spare for a rainy day. So all of these things come into consideration, and then we try and get you guys on a screen share. So that means you can see us, we can do video calls or come in and meet us for a coffee. And when you're on a screen share, it really helps. Once you see us, we can show you our screen. We can walk you through cities, because typically the city you live in probably won't be the best buy-to-let city. If it was, you probably wouldn't be phoning us in the first place. So the reality is that the better cities out there have been places where you're probably not going to be living. So we want to educate you on those cities, why they're so good, what makes them such great places to invest. And then we can then go through the development. And once we put that plan in place and you're happy, we can then do maybe a financial plan. Once you've spoken with a mortgage broker, get a rough idea of what you're looking at in terms of paying out for a mortgage. And then, of course, we can put a 5-year plan together so you know where you're going to stand in 5 years' time. So, well, look, I think that's all the questions, guys. Hope that makes sense. Say thanks for joining us again on this webinar. What I'll do is we'll get in touch with you, say over the next week or so. And if there's any questions at all, so you've got my details there. Feel free to email me personally. I'll get back to everyone within 24 hours. I look forward to speaking to you all soon. Take care.